You're failing the smart money concept and price action, and you can't find a good reason as to why. Now, as a trader, have you ever thought of liquidity and inducement during your trading? If not, then you don't know the real secrets behind inducement and liquidity. Liquidity and inducement are two of the most critical concepts of smart money that you must understand before placing any trade. In this video, we are going to show you the secrets behind inducement and liquidity and the manipulation and traps that market makers set for you and how you can avoid such traps. So if that's something you're interested in, please give this video a thumbs up to show your support and subscribe if you are new. Welcome back, traders. Before explaining the manipulation and traps that the big boys have prepared for traders, you should be able to detect the possible inducement and liquidity zones in the market and know their exact definitions. So let's start by understanding the definition of inducement. Inducement occurs at a specific zone in the market where traders believe it is the correct time to enter a trade based on their analysis. Now, on the side of market movers or the big boys, it is a trading system that market movers use to fall retail traders into their traps. Now the question is, how can we find inducements? Most of the time, inducement appears at specific points and zones, such as order blocks, support and resistance levels, swing highs and swing lows, and trend lines. So let's start with the order block. As you know, guys, order blocks are optimized supply and demand zones that every time price reaches them, it may change its direction to the opposite way. Around order blocks, there are always many buy and sell orders. This creates a large number of inducements around such zones. So an order block is an inducement level where traders get induced into the market and always place their buy or sell orders. As you can see here, price reached the order block. Most of the retail traders were excited and got into the market, or they got induced into the market. The price then first moved up and these traders were confident with their analysis. But see, the price moved downwards, hitting most of retail's stop losses, and then moved up. This is how market movers manipulate retail traders. So guys, don't worry, I will show you how you can avoid such traps, so make sure you watch this video till the end. Next, zones where inducement occurs oftentimes are support and resistance levels. As we all know, all traders consider support and resistance as levels that price will change its direction, and they respect these levels every time price comes back to them. So most traders always get induced into the market when the price reaches these zones. For example, we have this major support zone that price is rejected from it multiple times. Traders get induced into the market every time price comes back into this area by hoping that the price pushes to the upside. They set their buy orders at this area and finally get induced into the market. But as you can see, price pushed a little high before going down and hit the stop loss of the traders by this long bearish candle which they had positioned in the support level. So guys, this is an inducement, and this scenario has been designed by market makers. Next, we have swing highs and swing lows. Swing lows and highs are the points on the chart that might behave as inducements. As we all know, swing highs and swing lows are the highest and lowest points on the chart where the price has recently hit. So traders always get induced into the market in swing highs and swing lows. For example, here on Canadian dollar USA dollar 4H time frame, we have this swing high as the highest point that the price has recently hit, and we spot this point as the swing high where most of the retail traders place their sell orders. At swing high, with the argument that price will respect these areas and will change its direction when reaches them. As you can see, price makes fake breakouts in these areas and hit the stop loss of sellers, so guys, we consider them as inducements. Lastly, trend line. It frequently acts as an inducement, A trend line is a line drawn over pivot highs or under pivot lows to show the prevailing direction of price. In simple, trend lines are support and resistance that occur at an angle in any time frame. Most of retail traders consider trend lines as their possible entry points and get induced into the market. For example, here we have this trend line that the price touched times, so retail traders would get induced and take a short position each time price reached the trend line. At the fourth touch, the price does not respect the trend line, and it takes most of the retail traders who went short out of the market by hitting their stop losses placed above the trend line. Now we have seen how traders get induced into the market, but did you know that as a smart money trader, inducement is advantageous if you know the right way to analyze the charts? Here is my point. Inducement can be used to identify the market liquidity zones. Additionally, it enables us to move with market liquidity and take profits instead of getting trapped in the liquidity of the market's major players. Now we know the basics of inducement. Let's understand liquidity. Liquidity simply means money. Market always needs to sweep the liquidity to gain momentum. Now where we can find the liquidity. But before that, we have to know that liquidity is a zone on the chart where a large pool of money is resting, such as stop losses and buy or sell orders, because when somebody gets stopped out of a position, that money gets taken by the market. So this is a scenario designed by central banks or big financial institutions. They manipulate the market and make traders believe that they know what is going on with price action, and most of the time those traders are wrong, and they end up falling into the traps and finally lose their capital. Now, if we want to survive in the financial markets as profitable traders and prevent huge losses, we must be able to properly identify the liquidity zones on the chart. Where are these zones? These can be zones below equal lows and above equal highs, below swing lows and above swing highs, below and above trend lines, above and below order blocks, below the support and above resistance zones. Now we have understood both liquidity and inducement. So what is the difference between liquidity and inducement? Simply, liquidity takes traders out of the market, while inducement forces traders into the market, making traders end up being trapped in the market. Remember, these are the traps market makers design for retail traders to get on the wrong side of the market. Now let's see how we can use inducement and liquidity in our trading plan to avoid getting trapped. Here is a simple drawing. We have a bullish market structure that broke above the recent structure, leaving behind unmitigated order block and a zone I consider to be an inducement zone. The reason why I call this zone inducement is because price tried to move downside to reach the unmitigated order block but failed and turned upside, breaking the recent structure and leaving behind a zone that most SMC and ICT traders may mark as their new order block. But in an actual sense, this is a trap that is set by market makers to manipulate retail traders. See, the price reached the inducement zone and makes a tiny pullback to the upside. This pullback excites SMC and ICT, giving them hope that their analysis was right. Now watch. There is a lot of liquidity resting below this inducement zone. So according to my analysis, I wait for the price to first sweep this liquidity and reach the unmitigated order block, and then I take my trades. Price sharply moves below the inducement zone, sweeping the liquidity below, reaching the unmitigated order block, where it gains more momentum and moves to the upside. So guys, this is one of the ways big financial institutions manipulate or trap retail traders. Let me show you another way they trap retail traders. In another scenario, we have price moving in a channel, but if you clearly see, price action traders set their orders each time the price reaches around these trend lines. So this is another trap these financial institutions set for retail traders. Around this point, These traders were stopped out as the price moved out of this channel to sweep the liquidity resting above and mitigate this order block before moving back downside. Now let's see an example from charts. Here is a real example where the price is trending in the channel. The price then moves out of the channel and sweeps liquidity that had been accumulated above the channel before it proceeds downside. In another example, we have this supply zone that I consider to be an inducement zone because of the liquidity resting above this zone. Price reaches this zone and it makes a little pullback to the downside where it gains momentum and pushes to the upside. Here it sweeps the liquidity which is resting above this zone. If you clearly see, price after sweeping the liquidity and mitigating the supply zone, it reversed to the downside. So, fellow traders, I advise you to always take your trades after price sweeping the liquidity and mitigating order blocks that appear below or above these order blocks. If you enjoyed the video and want us to keep making more videos week after week, please be sure to click the subscribe button and turn on the notifications bell. Thank you and see you in our next video.